Hi again, everybody. It's Friday, February 20th, 2009, and I'm here again with Greg Newton, who's probably getting tired of talking to me. How you doing, Greg?
I'm doing fine, Dave, and I just hope people aren't getting tired of listening to us.
Anyway, well, folks, it was a pretty crappy week. How's that? The S&P was down another 6.75%. I don't know. I think we pretty much escaped with the skin of our teeth. But what positions we had certainly didn't work out very well. However, we didn't have big positions, and then we've been compensated a little bit by our precious metals positions. But nevertheless, we're not off to a great start on the year, but we have 90% cash or thereabouts and ready for whatever happens next. Now, I would say the markets are really oversold based on just looking at my daily McClellan oscillator, which puts us down probably to a negative 100. But nevertheless, bonds and currencies are all over the place, and we have a $94 billion in bond auctions next week. A lot of people are worried that the Fed will buy bonds as the Treasury is selling bonds. It's kind of a convoluted idea that one hand is buying and the other is selling, but we're living in strange times. Greg, any thoughts?
As far as I'm concerned, you had fairly heavy selling in the banks on all this nationalisation chatter that's been going around, and then late in the day the British press secretary came out and said we believe in private sector banking, and so all the banks rallied again. Most of them, they didn't get back to even, but there was a nice little late day stick save, and of course with options expiry at the same time there was some pretty heavy volume. I believe that Citibank and Bank of America together did 1.4 billion shares today. So
it hasn't been a market for investors. It's been a market for traders.
Yep.
And it's a market of trading desks and option pits and guys trading futures and program trading and all that stuff. That's what's really going on, because Mr. and Mrs. America aren't really involved in the market in terms of calling their brokers up and say, gee, I want to buy some Citigroup or something. That's just not happening.
Yeah.
And if the press secretary's announcement today was actually more confusing. We believe in private banking. Okay. When? After we buy the banks, then we'll sell them back out. So I think there's just a lot of confusion and trial balloons, and from my perspective anyway.
What we need to keep in mind is that these are deeply embedded problems. These are not things that, if they had simple solutions, they would have been dug up long ago. But what is different this time is that you have heavy leverage throughout the system, from the banking system to the consumer, and that there are no easy solutions. And whatever solutions are put in place, whether it's $800 billion worth of stimulus or porculus or whatever you want to call it, that's going to take time to flow into the economy. You've got the employment situation, you've got all manner of things going on, and we are in a bear market.
You're right. I mean, it's a bear market.
We'll get rallies, but we'll get downdrafts as well. And these little tantrums that Wall Street throws from time to time about whether or not it's what Mr. Geithner did or didn't say are pretty irrelevant in my view to the overall scheme of things, which the big picture is we're in a bear market until we're not.
Well, obviously the star of the show this week was, of course, the precious metals, and they're really giving a Bronx cheer to the government, to the situation in general, and proposed plans, and, the whole thing. There's just a lack of confidence, and it's expressing itself in what's going on in precious metals. Certainly, can be no argument about that so far. Of course, the rant of the week belongs to Rick Santelli. What did you think of that?
He made some very valid points. The point he was making, which was that please excuse the expression, but the wise virgins are essentially being raped again. The other thing is that whether doing nothing, a thesis that he's propounded for a while, would be as effective or any more or less effective than what is being done at the moment is something we're not going to know, because...
Well, he definitely picked the scab.
Oh, no question.
Undercurrent of real anger. And something I posted, a couple of weeks ago anyway, was people are pissed off.
Yes.
And his point of view is shared by a lot of people. There's a lot of rage out there and hostility. This stimulus package, which I think is just a big nothing. If you take a guy like Arlen Specter, the senator from, I don't want to go down this road too far, but says we have to do something. Well, it's like you just said. I mean, this is going to take some thought, and not just let's just do something, and it's going to take some time and thoughtful kinds of programs instead of just throwing a bunch of crap out there from taxpayers' money, and that's what's pissing a lot of people off, in my opinion. Now, Greg, let's move to something even more fun, which is our friend Madoff and this guy Stanford. And I read this morning that according to the trustee, this guy hadn't made a trade in 13 years. Did you see that one?
I did. There was the first big creditors meeting in the Madoff situation was held today, and that's where that comment was made. That is going to turn back on what the regulators. For clarification purposes, I believe that reference was to the trades and the accounts of the investors who were in the Madoff products, as opposed to Madoff's market-making business. Now, both those operations were under the same corporate entity, which, again, whereas the regulators have argued that they couldn't look at the investment advisor because it was different to the brokerage operation, is not strictly accurate because there's only one corporate entity involved, and this just raises more questions about what the dopes at FINRA and the SEC were actually looking at all those years. It is kind of incredible, but the stuff that's coming out of that and out of the Stanford story at the moment, just further evidence of what a lot of us have felt, if not known for a long time, is that the policemen were all down at Dunkin' Donuts having coffee and swapping stories while this pillaging was going on.
So what you're saying is that the Madoff hedge fund, such as it was just one big discretionary account in the broker-dealer?
Well, the receiver today said that was something over 2,300 people have reported losses. So there was some 2,300
separate accounts. Separate accounts.
Separate accounts. Yes.
Wow, what a big job this was to even do this whole thing. You know, that's why it couldn't be just him.
Yeah, one of the comments that he did make by criminal investigation is he said he knows how the accounts were fictionalized and manipulated. But it's just a pretty extraordinary story, and we're going to hear plenty more as this thing rolls out.
Oh, yeah, we'll probably hear about this for years to come.
No question.
Yeah. Then Stanford, I wrote yesterday that all these poor Venezuelans who were trying to escape the currency controls and the seizures and problems that were going on in Venezuela with Chavez wound up in the arms of Stanford, which is just really must be just mad.
Well, yeah, there's lots of people have wound up in his arms, and I certainly knew about the existence of his Antiguan operation this week, and if anyone wants to read the details of that, it's pretty prominent on the SEC website, but until that case was filed Tuesday this week, the details about the RAP program he had and the domestic operations were pretty extensive. I mean, he's had little regulatory go-arounds for 10 years or more, but in relatively recent years, there's been various FINRA actions making unsubstantiated claims, and there's been all sorts of regulatory red flags that just don't appear to have been followed through with. That we've referenced FINRA, and remember that it's the chief executive. FINRA is now the chairman of the Securities and Exchange Commissions. It's going to be interesting to see how all that gets covered up over the next few years. The FBI tracked him down to the general neighborhood of Fredericksburg, Virginia yesterday and managed to serve him with the papers relating to the civil action, but it may be some time before we see any criminal action.
This guy Stanford created some names for himself, or he alleged to be descendant of the founder of Stanford University, and got himself knighted and all this crap. 16% returns on CD, and that lasted 6 months or so before it all blew up.
Yep. No, some of these smaller ones that come to everybody's attention again. Just this week, there's one in Hawaii apparently targeting deaf people of, all the affinity frauds, which was very similar. I mean, the money was going into houses and cars and private jets that everybody said, well, these guys must be good because they've got all the toy.
Greg, one of the other things that was going on that I found interesting was this UBS story having to do with the disclosure of names of investors.
There's a story, obviously, there was that big settlement where they agreed to pay $780 million or something for basically helping people dodge their taxes. They've handed over 250 names. There was another suit filed yesterday by the IRS looking for 52,000 names. So the number of people who are believed to have been coming up somewhat short on their obligations to Uncle Sam are, somewhat larger than was first thought. So, but this is one of these things that is just going to run as you have the clash between the, Swiss banking secrecy rules and the interests of the IRS getting a list of names. And despite the settlement of the earlier suit, which involved the Department of Justice and the SEC, you have this IRS issue opening up. Whether it's a tax fraud or a securities fraud, they're the gift that keeps on giving.
All right, then. Well, that'll do it for us this week, folks. And Greg, thanks for being with me as usual.
My pleasure, Dave. Talk to you next week, everybody.